EIP is a program at AUC School of Business. What we do is help support the entrepreneurship ecosystem within the university and outside. We help in organizing events, business plan competitions, entrepreneurship activities, and we also have other plans in the future to working on an incubator, a business incubator inside AUC. So we have been working with many partners within the ecosystem, including Intel Capital, including other people who are involved. So I basically am happy to welcome you all here. Mr. Feroz, he is heading Intel Capital in the Middle East. Intel Capital, I think they started in 1991, and since then they have made more than 1,000 investments in the region, in 45 countries, covering more than $7.5 billion. Most of their investments are actually outside of the US, and they've made a number of investments he can definitely talk more about in the region. I think one of them, you can also talk about your latest investment in Egypt, which is probably the most interesting. So I will not take more time from Feroz. Please welcome him, and welcome to AUC.
Thanks. Who's a student here? Okay. What are other people doing here? They just came to see me, or? Yeah? Okay. All right. So this is your day. So whatever anybody wants to hear, I'm happy to talk about. What I'll do is I'll kind of give you a broad brush idea about venture capital, so that everybody's kind of level set on what we do. Then what we can do is we can explore a little bit about the ingredients that makes a good investment. Anytime you want to stop me, that's fine as well. And the second thing that I do when I talk is that debate is always a good thing. So if you don't agree with me, don't be shy. Tell me you don't agree, and we'll talk about it a little bit, right? And fairly frequently I'm wrong, but you know, that's the nature of the game, right? So nobody is always right in this business. Venture capital is a very soft game. It's not hard science. So what you'll realize is that a lot of investing is figuring out the right team, the right technology, the right market, the right timing, all of that put together. So if you look at all of that and you figure out what are you looking for, you'll realize that a lot of these things are very soft. They're not numbers that you can say, oh, I have a checklist and I'm going to go check, and I'm going to invest, right? It all depends. Everything is negotiable, right? So if I start from the very, very beginning, you can look at companies that are early, which is started by two guys in a garage, right? Steve Jobs and his buddy started Apple, right? Long time ago in a garage, right? Or you can look at medium-sized companies, 20, 30 people companies. An example would be SysDsoft that Intel bought, right? Or you can look at larger companies. For the sake of argument, let's look at one of your companies, or Ascom. They're a fairly large company, lots of different business divisions. There are three different sizes of companies in the continuum of companies, right? I will not focus on the big companies. I won't focus on Intel, right? I'll focus on the early stage stuff, which is the startup of entrepreneurship at the very beginnings of entrepreneurship. When you start a company, or when you think of starting a company, right? That's the thing I'm going to take, right? In the middle, if somebody wants to cover the other stuff, I'm happy to do that, but that's not my talk today. My talk is about very early stage stuff, right? When two people decide they're going to start something, and the question is, hey, do I get a job, or do I sleep on a couch, right? Those are only two choices you have, right? So you got to figure out at some point in time that decision in your mind. Do I get a job, or do I, survive on very little money, and you're probably not going to be fired anytime soon, but that's about it. That's where you'll be stuck. You'll wait for your promotions, etc. You'll be like me. Right? If you grow in the company, you'll do fairly well, right? If you're good, you're bright, you'll do fairly well. But that's about your upside, right? Now, if you sleep on your couch and you develop something from scratch, your upside is unlimited. Totally unlimited, right? And that's really something that you need to figure out. But the risks are incredibly high. The risks of failure in that space are huge, very, very high. Right? 9 out of 10 companies fail in that space. So the question you have to ask yourself is, what do you really care about? Right? Now, I've lived in India, I've lived in the US, I've lived in Europe, and I've come here in the region, and the concept of risk of failure is a very difficult concept generally in the Middle East, and we are trying to change that. We are trying to change the whole concept of what failure really means, because Silicon Valley has developed this culture of failure and done a great job at it. But Silicon Valley generates billions and billions of dollars of economy every year, right? And the reason it generates that is because they're not scared of failure. Failure for an entrepreneur is very normal, right? I have known people who have started 7 companies and failed in every one of them, but the 8th one hits, right? Or they started the first one and the first one hits. You can't predict that. You can't predict markets. It's unlikely you're going to predict your future. It's unlikely you're going to predict your timing. And it's more and more unlikely that you will be able to look at the whole thing from an overall perspective and say, this is going to be successful. I've yet to, by the way, meet an entrepreneur who comes to me and says, here's a business plan, I'm going to fail. Right? Nobody will do that, right? Because they're not going to get funded. Everybody will come and say, here's a business plan, fund it, it's a great business. Right? But the likelihood of that business to fail is still 9 out of 10 or 8 out of 10. Right? So that even though they have a good business. Right? So let's kind of peel back and see what are the key ingredients to making businesses start up, flourish, become bigger. And all I can do is de-risk it for you. Right? I can't change the profile. I think the capabilities will remain the same, but I can de-risk it for you. Right? So the first thing I look at in early stage businesses is the team. Right? So let me give you some example of what I mean by team. Right? So, you know, an example is in my 5 fingers, right? Or 4 fingers and a thumb, as they call it. And as you can see, I can grasp things very easily with my hands, right? This is my thumb. It opposes my 4 fingers, right? And that opposing force catches things, right? If I just had 4 fingers, it would be difficult. If I had just 1 thumb, it would be still very difficult to grab things, right? That's what makes a team. Right? Engineers, management. Engineers, management. Whatever you want to look at it. A team is made up of a bunch of people, and they're not always doing the same thing. Rarely are 4 engineers, just engineers, going to make a company happen. Google didn't get built that way, by the way. Right? If you think that Google got built that way, you're wrong. Sergey and Larry were engineers, but they wanted an Eric Schmidt to come in and make the company happen. Eric Schmidt had nothing to do with technology. He probably doesn't understand much of it. But he's a master at communicating it. He's a master at marketing it. He's a master at doing other things, building a group of people, right? Rarely are people able to do things themselves. So the team work is important because that team grasps business, right? Any missing part, and you're in trouble already. Right? So the first thing I look for in any kind of early stage company is who's the team? What is the background? You know, are they all a bunch of engineers who are trying to develop a product, thinking that the best technology is going to win? Because I can guarantee you, best technologies don't always win. Right? You know, a third-tier team selling a first-tier product generally fails, but a first-tier team selling a third-tier product generally wins. Right? So if you think Google was the first in search, you're wrong. If you think Facebook was the first in social networking, you're wrong. If you think Skype was the first voice over IP, you're wrong, right? Because all of those first movers failed, right? Second, third, fourth movers came up and built something from the ground and took it somewhere else. So the question is, why did they do it, and why couldn't I do it, right? Why did Nicholas Zenstrom and Tom win the Skype battle versus a company before that came up with the same technology, peer-to-peer voice over IP? Fail. Right? What is the difference? And that, by and large, is your focus, your team, and the people, because it's a people business. Right? It's not a technology business. And the last ingredient, which you always have to remember, is luck, which plays a big part in this game. Right? Early stage companies also need a lot of luck. But that luck can be turned. It can be turned by networks. It can be turned by people who help you. It can be turned by mentorship. It can be turned by bouncing ideas. It can be turned by not being scared when somebody says no. Right? So a lot of that thing can be turned. Right? So the first thing I'll say to you is make sure that you have a good team. Right? That would be my first kind of thing. I was looking at a company in a box, about 80% of that box, roughly for me, would be the team. A good team, pushing out good ideas, generally is what I would look for. All right? So if you're thinking of starting a business, start thinking early who your partner is going to be. Next thing I'll talk about is something called generosity, right? And the opposite of generosity is what? Selfishness, right? Generosity is one side, selfishness. So when do you think the company has to be generous, and when do you think the company has to be selfish? Any ideas? Anybody? Early, late, when?
They should be generous at the early stage. At an early stage.
I think they should be simultaneous, like always, like generous in terms of a vision that,
No, generous in terms of giving away equity.
oh, in terms of giving away equity?
I come to you and say, you got a business, right? Right? So you come to me and says, I got a business idea. Right? I want you in my team. Right? So I say, okay, I'll be a part of your team. What are you going to give me? What are you going to give me?
I'm giving you my idea.
No,
Wait, no.
wrong.
I'm not giving it, but I'm sharing it because I'm getting something.
Ideas are all over the place. Ideas are worth zero. It has no value. That gentleman was right. Generosity comes at the early stage of a company when your value is zero. Because at that time, you need to collect your team and you reward them with equity. Because equity is worth nothing at that time, right? Because you have no value. But you don't give them cash, right? Why? Because cash is the most important asset you have at that point. The first $50,000, $100,000 you're going to get from your family, friends, wherever, is going to be the most important asset you will have. You need to preserve that. You don't want to burn that. Because if you burn that, your runway is gone, right? So you're a plane flying, trying to fly, right? But before you could take off, your runway ends, right? Your cash is gone, right? So the generosity begins at the early stage of a company when you're collecting the team. So you reward people and management by giving away your equity. Very counterintuitive, because people always say, oh, it's my company, I own 100% of it. You know, I'll write you a salary. Nobody cares about salaries at that stage, because they want to be a part of your team, right? They want to be a part, right? So even in the late stages of Google, when people thought that Google's going to win, Eric Schmidt still owns roughly 12% of the company. Imagine that. Imagine what 12% of Google is like. Several $1 billion. Because they believed that he, as their first CEO at that time, now he's not the CEO, he's moved on and Sergey is back, was going to help them become what they've become. So their approach was that 1% of a $1 billion company is better than 100% of a zero value company, right?
Yeah.
Because 1% of $1 billion is a lot of money. Right? Most people don't have that. I don't, right? And 100% of a zero value company is zero, right? So generosity comes early. You become selfish later in life. Why? Because once you prove the business model, when you prove that you've achieved something, when you prove that you're going to get to a certain goal, and a venture capitalist like me comes and says, I want to invest in your company, you can say, oh, my company is worth $50 million. And I say, oh, it's too expensive, 50 is too much. Well, prove the business model, I've got a good team, I've got a great market, I'm succeeding, take it or leave it, right? Then you become selfish, right? Because then you become dilution sensitive, and the less you dilute, the more wealthy you will be, right? So you have to understand that early stages of a company, to build that team requires dilution. Later on in life, you can ride that dilution out. You can put some contractual terms that basically says, I'm going to take back my equity, I'm going to buy it back, I'm going to claw it back, whatever you do, right? But at the early stages, you can't afford to do that because you've not built your team yet, and you have to build that team. Without that team, you will be nothing, right? So it's very important to understand how that works. Now, you have to also realize that I'm speaking from a venture capitalist perspective, and I'm talking about venture capital. Not all businesses are venture ready, right? I'll tell you, most businesses in the world are family businesses. They never raise venture money. They don't raise any money. In fact, the family pays for it, and they run a business. And they go off. It doesn't have to go public. It doesn't have to exit, whatever. So, there are other businesses as well. What I'm talking about is purely venture capital type businesses where investors come in, because investors want liquidity, and liquidity is when you sell the company, right? So that's the perspective I'm taking in this talk. So that's the second part, right, which is basically the concept of when do you give and when do you take, right? Third product is going to be product and services related, right? So when you develop your product and service, right, you have to think to yourself, who are you catering to and what gap are you trying to fill, right? It's just not good enough to say, oh, I have something that will change the world. The question I'll ask is why? Why will it change the world? What problem are you solving? What gap are you filling, right? What market are you addressing, right? So you have to think all those things out to look at it from a holistic perspective and say, oh, I'm filling this gap, I'm filling this issue, right? Et cetera, et cetera, et cetera. That doesn't mean that all companies that don't have that fail, because there's one more missing ingredient, which is execution, right? Even a badly drawn idea executed well generally wins, right? Generally wins. So execution is a very, very key element in this picture as well. But if you are shaky on execution, you better have something that people go after. And the third vector in this is something called network externalities, and you'll learn about it in business. Network externalities is the more people that join something, the more valuable the life gets, right? An example is Facebook, right? The more people that join it, the more valuable Facebook gets. Not because they're making more money, but the utility of that process increases. Because you go to your friend and say, oh, I want to send you an email. The guy says, oh, send it to me on Facebook. You say, I don't have Facebook. Well, you don't have Facebook? I mean, everybody else does, right? So, do you understand what I'm saying? So,
Yes.
Immediately, the utility of something increases because of the network effect, and the network gets that. So, those are the three concepts which kind of give you an idea of a product or service, execution, and network externalities. And network externalities generally work in technology businesses where the world is flat, right? Because broadband connects us all. We can get online and talk to somebody in Taiwan, China, Latin America, wherever, and it can be seamless, right? So generally, when you're filling gaps, you have to ask yourself a question. Are you going to chase the customers, or the customer's going to chase you, right? Because if a business comes to me and says the customers are going to chase me, I'm very interested in that. And I say, well, why? Why do customers care about you? Right? And why are they running after you? You must have something. Right? And if somebody comes and says, oh, I've got to go and I've got to build a sales team, and I'm going to go out and to do this, and I've got to, I build this application, and suppliers are going to put their, so I'll give you just an example. I built this platform, and suppliers are going to put all their stuff on it, and the buyers are going to come and buy all that stuff, and I'll make a percentage out of it. And I say, oh, great. Do you have any suppliers? No. Do you have any customers? No. Well, how are you going to do it? Right? Who's chasing who? Right? So it's important that you build something that has momentum on both sides, supply side and demand side economics, right? And when you're building supply and demand side economics, at some point in time there's something called tipping, right? Everything tips over. So you're building. It's that little Jenga thing, right? And ultimately it tips over and falls. And that tipping point comes in when you reach that state, and then people come to you. Amazon reached that, well, when Amazon started, everybody thought that this was the worst company ever, right? For a while, they were just a bookseller, right? They had big warehouses, they put books in there, people ordered it online, they shipped the books, huge infrastructure cost, and then the Kindle comes. Now, when the Kindle comes, guess what? Completely disintermediates the book shelving process. Because you can sell something online in a second. You press a button and the book is on your Kindle. So why do you have to stock all these books in a warehouse? You don't need to, right? It's a waste of money and waste of time shipping something when you can buy it instantly. So you see how when it started, it was one company and it evolved into something else, and then people start chasing you because they go, this is great. I can buy it. Just open a book, I'm done. So the product and service makeup is very, very important to consider when you are looking at a business as well, right? The next concept, and by the way, I'm not going to be comprehensive in all the concepts, but I'm just sharing with you some things that I care about. The next concept is about how you structure things, right? how do you structure your business? Are you structuring your business to be investor-friendly or not investor-friendly, right? And investor-friendly businesses generally are really well-governed businesses, right? They're governed businesses because you make sure that there is transparency on transactions, right? Whether it's a supplier transaction or a customer transaction, there is transparency. I can ask you a question and say, show me X, Y, and Z, and you can say, yep, here it is, right? And when you can show it to me, I as an investor feel a lot confident that you're sharing with me the way things are, the good, the bad, and the ugly, right? And by the way, the faster I know the ugly, the better I can make decisions, right? Because guess what? Ugly doesn't mean that you're not going to get investments. Ugly only means that you've been upfront and told me, these are my kind of soft areas that I need to get a CFO. I don't have one. My bank accounts are a little sloppy. My structuring is a little bit poor. I need to fix that. Well, guess what? We can help you with that, right? VCs do that all the time. I do that all the time. So that part of it is kind of an interesting part that you need to be able to think about from a structuring perspective to keep it investor ready. If you're going to run the company for yourself, and it's a family company, who cares? Do whatever you want to do, nobody cares, right? But then, you're never going to be a public company. It's unlikely you'll ever float the company. And it's unlikely you'll ever exit it unless there's a lot of cleanup. And guess who makes the most money on those kind of things? Consultants and accountants. Because they come and clean up your company, and they take the big paycheck. And lawyers. Forgot about the lawyers. So that's important as well when you're looking at the overall company from a structuring and governance point of view. And I can't stress it enough that it's important you do it from day one, because it's a discipline that's important that gets you going. All right? Another concept I'm going to talk about is exits. Every company ultimately has to have some sort of an exit, because me as an investor, I want my money back. Right? So how do I do an exit when the entrepreneur has not even thought about it? You haven't thought about an exit. How do you think I'm going to think about an exit? Right? How do you think I'm going to exit? What makes me liquid? Right? And it's important to start that process early. And I always tell people, have a goal in mind. Do you want to be a $10 million company? Do you want to be a $50 million company? Do you want to be a $100 million company? Put a goal. Right? And by the way, not all companies will be $100 million companies. I guarantee you that. Right? And so you can't come down to me and say, oh, by the way, I've got a $100 million business, because I might just say, go away, right? Or I might just say, show me 50 and then come to me, right? Or you can come down to me and say, you know what, I'm only looking for a relatively small amount of money. I'll give you a good return. It's not going to be a stellar return in terms of amount and size, but it'll be good enough. And I might be interested, because my cash-on-cash multiple might be good, right? Because that's how we are measured. We're measured on cash. You put $1, you take 5 out. Because remember, venture capital is not a business. We're not in the business of dividends. We don't really like dividends. We don't care about dividends. We care about multiples, right? So in general, if somebody says, oh, if only you can give me $1 today, or $10 today, I'll return you $1.20. I guarantee you, I'll give it back to you. I'll make this company and give it back to you. Why would I do that? I want that $1 to turn into $10. So turn my $1 into $10. That's what interests me. And that's what I care about, right? Because if I invest like that in 20 companies, maybe, one would succeed, or two would succeed, and the rest would fail. And that would pay my bills, right? Because somebody's got to pay my bills at the end of the day, right? So it's important that you start thinking of exits early, so that you have some goal in mind. Because you're going to throw your entire group of people with you. Right?
As a VC, what's your favorite technique?
So I'll talk about Intel as a VC, and I'll talk about VC, right? Intel as a VC, we are never good at spotting Googles and spotting Facebooks and spotting Skypes and spotting whatever. We're never good at that. But we're a consistent player. What I mean by consistent player is that you'll see in our portfolio lots of companies that exit at about $1 billion valuation. But you won't have necessarily heard of them. They may be in obscure technologies that are filling gaps. They may be in issues and solutions in software that you probably won't touch because they're business-to-business related stuff. That's really our sweet spot is Intel. Right? That's where we go. I'll give you some examples. I mean, last week I was in Dubai for GITEX, and I had lunch with the founder of RIM. Right? Everybody's a BlackBerry. And he came and said, "Oh, come sit next to me." So I sat next to him, and he says, "Do you know so-and-so?" I said, "Yeah, of course, I've been in Intel a long time. Of course, I know them, etc." He says, "You know, I still can't thank you enough for investing in us when we were worth nothing. We were the first investors in RIM." So that gives you an idea that, you know, you would know that. If you Google, you might find it, but you would generally know that. So we build these platforms. We are good at that, right? Platform builders. But we're not good at hype builders, right? We're not good at Googles and Facebooks and other stuff because it's hard. I mean, you know, Twitter comes along and tomorrow it might not exist. Facebook comes along tomorrow it might not exist. Who knows, right? And the important thing is that mostly infrastructural and platform-related stuff survives. Everything else could potentially go away, right? Because markets are fickle, and those can go away. So if you ask me 10 years from now what would happen, I would say, I guarantee you Google might, if they don't keep evolving, Google might fall. If Facebook doesn't keep evolving, they might fall. Right? Somebody else might come and take over. Twitter, I have no idea what they're doing. Right? They got millions of people, but I have no clue what they're doing. Right? So Zynga makes money, so they obviously clearly have some idea. Groupon, I have no idea what they're doing. Right? I'm interested in the model, but how sustainable these models are, I really don't know. But you see, hypes and falls are good things in economics because that's what makes things happen, right? You know, you want that, you want exuberance, you want energy, you want people to be excited. And you want also for them to fail occasionally because that's okay, right? Failure is a part of it, right? And I've seen billion-dollar companies go down to nothing. So don't expect that, you know, I've reached $1 billion valuation, I'm going to be here forever. No, not true. You know, Pets.com raised $80 million. It's a bankrupt company, right? I mean, how do you go to the market and say, I raised $80 million and now I'm worth nothing? I mean, that's scary, right? But it happens, right? And bubbles do form. But that's okay, right? In the marketplace, economically, that's okay. So in general, just to give you some idea of concepts, once you've looked at all of those things, the last thing you have to also figure out is that if you're a ship in the sea, you have to worry about the sea's depth, you have to worry about the tides, you have to worry about the wind, and calculating all of that, you have to figure out a way to navigate, right? You've got to go in one direction or another direction. Because if you don't choose a direction, the wind will take you wherever it wants to take you, right? And it will. Right? If any one of you goes out in the sea and anybody has a boat, you will learn that you don't have to do anything. The wind will take you somewhere, and the tide will take you somewhere else. So you have to make deliberate choices in direction to go to somewhere, and it's a deliberate choice, right? It's not something that randomly is made. So competition, right? Environment, economics, timing, all these things have to be looked at on a constant basis, right? So you almost do it like a, you know, the airport has this radar light that goes around in circles. You almost have to do it like a radar. You have to keep an eye out for what's happening out there. Right? So why does Intel Capital exist, right? Well, Intel Capital exists because we are that radar, right? Because Intel learned a long time ago, 12, 13 years ago, that we were smart people, but we're not the smartest in the world, right? We're good at what we do. But there's something out there that we probably will never ever see, because it's something out there that a couple of people will come up with that will always try to be fast forward and disruptive, or whatever you might call it. And so Intel Capital was created to keep your eyes and ears open to this. So we are that radar who kind of keep monitoring outside the world what's happening. I was telling Nihal, I rarely go to my office because I don't get much out of my office. I stay outside. I go to people like you. I go to people outside the company because I hear from them, I listen to them, because that's the message I want to give back to my management. Oh, gee, this is happening, or that's happening, or do you know that there's an iPad coming? Right? By the way, that dialogue actually happened at Intel. And we were told that iPad, that's like a big iPhone, nobody will buy it. Right? Well, what's happening today? Right? But we were the radar. Our job was done, right? I don't run the company at the end of the day. Somebody else does, right? But it's their foresight, right? So when we talked about disruption, we talked about eating from the bottom, right? And we looked at an iPad and said, you know what? It's a dumb device, but it's eating from the bottom. You know, by the time we react to it, it could be 2 years from now, right? And 2 years later, God knows what iPad's going to look like. So if you look at the iPad and what its functionality is, it's not as functional as a laptop, right? It has a lot of deficiency. It has no flash, no USB ports, no connectivity. Very simple device, right? It's the simplest device. It's elegant.
Competing with a laptop, isn't it?
Today it's not.
No, it is.
Today it's not, but tomorrow could
2
be.
days ago it is.
Yeah.
2 days.
Yeah.
Because now you don't need a laptop.
There you go. See, people are now starting to swap things, right? And so who knows? I mean, you could be right. You could be right that it doesn't compete directly, but who knows what 6 months is going to be like? Who knows what iPad 4 is going to look like, or 5 is going to look like, or 6 is going to look like, right? So do we have to plan today for it? Of course we do, because if we don't plan today, 6 years later we might be irrelevant, right? So you had a question.
I still don't understand eating from the bottom.
So eating from the bottom is when you have a large portfolio of products, like we do. So we sell a $200 chip, we sell a $190 chip, all the way down, right? All the way. So we're concentrating on our level of market. And then this device comes in that doesn't provide you all the goodness of a laptop, but comes in and supplants it slowly. It comes and says, okay, you're not going to do everything that a laptop does, but you're going to do something. Oh, you can browse, you can check your email, you can read newspapers, you can listen to music. And then you see, oh, well, that's what I do with my laptop, don't I? But what else do I do with my laptop? Oh, I create. I can do PowerPoints, which I can't do with the iPad. I can do Excel. And then I self-justify to myself. I justify to myself, oh, I'm so much better. I'm so much better than them. Why would anybody want to buy an iPad, right? And then this iPad moves one step up. And now it has a little bit of a creative tool in it. Oh, you can manipulate your pictures, you can change the colors, you can have 2 cameras.
Did you hear about the $60 Indian iPad?
Yeah, we'll talk about it in a second. Yeah, I'll get to you that. And then you take the next step forward. You know, this march of technology never stops, right? So now you go, oh, so it does a little bit more, but it still doesn't do this, and it still can't play MMO games, and it's still, you know, there's always a justification of still, all the while eating. Next thing you know, you've got a market which is that thin and that wide, nothing to show for it. We understand that. We do know that. We're preparing for it, right? But that preparation takes a lot of thinking. It's not as easy as, you know, saying, oh, my laptop is going to disappear. It's not going to disappear. Remember, we still sell multiples more chips in the ecosystem of PCs than iPad even has a market. iPad is not a big market right now. You may think it is big. You may think 18 million is big. 18 million is not a big number when you're selling 70, 80 million PCs. Right? So what happens is, right now it's a complementary device, but as you rightfully said, it'll start soon changing the game. And we have to figure out, just as any other company, just as you as entrepreneurs will have to figure out with your companies, who are these players and which way are they dragging you? And which way do you want to be dragged? Right? Because at the end of the day, you have to ask yourself a question. Do you want to sell the $50 chip, or you want to sell a $1 chip? And will you have the same margins? Right? You may not. Right? So you may just say, okay, you know what? There may be a billion mobile phones, there may be a billion of these devices out there, but you know what? It may not be a market for me, right, today, because it may not be the right thing for my factory. You know, a factory in Intel costs $4 billion to build. Somebody's got to pay for it. Right? Thankfully, all of you do, right? But somebody has to, right? Everybody has to pay for it. So that's roughly my talk. There are many other more ingredients along the way. I mean, I'm happy to shoot you something. I have a presentation. I'll send it to Nihal and she can pass it on. But at the end of the day, it's about bravery. It's about finding the right niche. It's about finding what you want to do. It's about thinking big, right? I was at Teak talking today, and there was a lot of debate about oh, why do we care so much about multinationals and what are they going to do for us, etc. And yeah, I think there's good arguments. But on the other hand, I flip around and say, you know what? I provide you with a platform to see the world. I provide you with a platform. You can call me and say, hey, what's happening in China? I'll tell you. Because I have other MDs that I work with who know China. The world is flat. So I always say, think bigger, think wider, think that the world is flat, and build for the world. Don't build just for a particular region or a particular small segment. Because if you build for the world, you might get a small sliver of it. If you build for a little region, you may be nothing. Now, the only differences are that you may want to figure out certain particular verticals that are so specific to your region that might just be special. And that's okay. But scalability of those models will be very, very difficult. So if you go to those models, you better be number one. Or don't play. Right? Because if you're number 2, 3, 4, 5, 6, you're irrelevant. Right? Because the market's not big enough. Right? And the last question was that we were talking about the ecosystem of what it takes to build an ecosystem in Egypt for innovation. And I think Egypt has all the ingredients to make a great ecosystem happen. You have research universities, you have smart entrepreneurs, you have workforce, you have engineers, you have networks, you have VCs. And the last item where I got stuck, which I couldn't justify because I was sitting for 2 hours in traffic, was quality of life. I got stuck at that one. I said, you know what, if people are wasting 4 hours of their life sitting in traffic, that's not quality of life. Something's got to be done. So I challenge you guys, figure out a way to solve that problem. And I'm not saying build more roads. Figure out a way to flatten that, and you'll be probably doing a good job for Egypt. Right? And one way I gave an example was that I think you should implore your government to make sure broadband connectivity happens for every citizen at the fastest possible bit rate. Because people can then work from home, people can contribute, mothers can take care of their kids and still be able to participate in the workforce, because that will add incredible opportunities for everybody, right? Because there is absolutely no justification to sit for 2 hours, 3 hours to go to work every day, and that really kills an economy, really badly, right? So at a high level, I was imploring them, saying, you know what, if you've got a broadband policy discussion, figure that out. Because there's so much more contribution that can happen from home than you believe. I hardly go to the office. I don't need to. I can work from anywhere. I'm a mobile worker, right? Why can't we all be mobile workers in many ways? Because it's the outcome that matters, not the input, right? So thank you very much for your time. Any questions about life in general is also fine. No problem. We'll try and answer them. Yeah.
First of all, question we have not necessarily capital, but I personally met Intel people in 1995, and then again in 2001, with the dream each time to the then presiding government of the famous $500 million factory, which never came to Egypt.
Yeah.
I understood it in 95, and I actually advised at that time not that we're not ready. Did not understand it in 2001, and I did not understand it again in the second half of the last decade, but I didn't need to Intel yet. How Intel took the decision to go to Israel or Jordan or whatever to set up a factory there. But that's a very nationalistic view.
Which is
And
good, by the way.
Yeah, I know. They want to hear from you the reasons, because those, I can understand going to Israel for reasons of democracy and protection of laws, but I can't understand going to another.
You missed one more item, but I'll cover it for you.
Okay? And that's one point. The other point is Intel and other VCs which are attached to companies are focusing on vertical, horizontal integration and technologies like that. And also always talking about that VC is all about finding those undiscovered. Trying, at least when going into the emerging markets, take the safe bets. Or don't do the investment themselves. Because with a little amount of money, if you intend to invest $500 million in the Middle East, you invest in the beginning 3 or 4 with an incubator, with the center at least letting people know what to expect and how you can, you will have a much better outcome. But I never saw, I saw it always as a reactive step. That's not an activation, it's an observation from a 17-year-old investment banker.
Who are you with right now? Who do you work for?
I run a company called Ad Finance, which is
Okay.
pure brokerage,
Okay.
but I've been with Citibank, Barclays,
Okay.
Fleming's,
Here in Egypt.
here in Egypt.
Oh, very good. Okay, so lots of questions. So let me try to address some of them as much as I have visibility of it. Right. You see, the concept of a factory is an interesting concept. This concept comes in to every country that I potentially go to. So it's not unique to Egypt. If I'm in Vietnam, they'll ask the same question. If I'm in China, they'll ask the same question. If I'm in Germany, they'll ask the same question. Right. And everyone has the right to be patriotic about technology and patriotic about building something. Our process of determining where to build, and by the way, it's getting tougher and tougher, has a lot of vectors. We look at a lot of things to make that decision happen, right? The number one criteria is talent, which I think Egypt has in abundance. Don't get me wrong, right? So that's the number one thing that we look at, right? So while you talked about democracy in Israel and you talked about, what you didn't talk about was Technion. Technion probably is better than MIT, right? And MIT is one of the premier technology institutions, right? So I think let's not forget that the first thing that we look for is people, right? So assume that that's in abundance. There are many other criteria that have to be looked at. Water, logistics, environment, and you name it, right? I'm just listing a few. And after all of that is said and done, we have to list a list of countries where we want to be. Because remember, we are moving product left, right, and center, right? I mean, we're moving from Phoenix to Ireland, to Israel, to Malaysia, back and forth all the time, right? And in a factory like Intel's, and I worked in a factory, by the way, we can't have 1 minute of downtime, right? Because a typical factory needs to pay itself off in 6 months, right? So there's a lot of hurdles. The last thing that you also need to determine is an ecosystem around it. A factory by itself doesn't mean anything, right? I have to have suppliers that supply gas, chemicals, all of those other things around it to be able to make it happen. Given all of that, and given all of the issues, we have to make some determinations on where we were going to go. And by the way, it's not just an Egypt issue. I think it's an Arab world issue, right? Because we have to look at it from that concept and context and say, when is it going to be we're going to be able to do something like this. You know, my job is to educate people internally, and I do a lot of that education because I see a lot of positive things, right? And I can't promise anything, but I think that education is a chipping process. It takes a long time, right, to be able to do that. Outside of the U.S., there's only 2 places that we have gone in a meaningful fashion. Ireland, where I used to live for 10 years, and Israel. Those are the only 2 places. And when I was asked to move from the U.S. to go learn about chip making, I chose Ireland, and I lived there for a long time trying to build a facility. And I'll tell you, the choice of Ireland was very simple. It was Europe, highly educated, and 12% tax. Right? Let's not kid about it. Very honest, right? We won't build in Germany. We won't build in France, right? It won't make any sense. That's that perspective. The second thing, the question was around Intel Capital and our investments in meaningful sizes versus lots of small companies. I beg to differ here, right? And I'll tell you why I beg to differ. I think I could probably find those bigger gems to invest in and put a lot of money in. But I think that's not the game I'm in. Because that game doesn't solve the problem here. The problem needs to be solved by changing culture and changing the concept of entrepreneurship, right? That solves a lot of the problems because even if you look at the Silicon Valley model, you wouldn't believe it, but 60 to 65% of the companies in Silicon Valley are less than 5 employees. Right? The fabric of Silicon Valley is built off of startups. 85% roughly of the companies are less than 50 employees.
only 6 or 7 companies have more than 10,000 employees. HP, Intel, Apple, Google, I'm running out of names now, Cisco, Oracle, HP. Wow, I don't think Microsoft has 10,000 people in the Silicon Valley.
Startups and small businesses.
Yeah, startups and small businesses is where the action is. And we have to accept that action and we have to support that action, because if we don't support that, then we're not doing our job, frankly, right? Because my message to my management is that there are a lot of young people, they're excited, they're enthusiastic, and they're going to make things happen. And it's not that I'm going to go and say to Najib, sell me some shares of Orascom, Intel will make a lot of money out of it, thank you very much, goodbye, we're done. Because it doesn't get us anywhere, right? So saying that, let me give you an example. I moved here in 2008, right? So it's 4th year. Right? And I look at my life, comparing it to what happened in Eastern Europe when we first went to Eastern Europe and the wall fell, right? It took 9 to 10 years after the wall fell for things to start picking up. Right? Remember that. So we're in early, right? We're in early. So I'm hoping that in the next 2 to 3 years, we will have a few exits, you'll have more SysD softs happening, more encouragement to people, and they will then start rebuilding and re-encouraging each other. Any other questions? Yep. Sorry, we'll do this one and then I'll do you, yeah?
I'd like to speak briefly about the moment that the young entrepreneurial team meets VC, which
Scary.
is an exciting moment. Now, first of all, if you're in technology entrepreneurship and VCs, which of course is only a part of the
Very small part, very small
market
part.
of entrepreneurship.
Yeah.
Now, also, regrettably in Egypt, a VC that has the time for a startup is a very rare phenomenon. I don't know much about your organization, but I know that when I go to Citadel, or to Hermes, or one of the others, the average startup doesn't get past to go out.
Yeah.
That's the reality. But anyway, here we're sitting at that table, the team does its pitch, and you're looking for a good team. My first question is if you, for this audience, could, in a bit more practical sense, explain the kind of things, the indicators that tell you the team is indeed a team.
Yeah.
And the second question is one that I very often see when I deal with young entrepreneurs. They're hell-bent to give themselves an evaluation. They want to put a number on how much their company is worth. I usually discourage that because it's very tricky grounds.
Did I not say 0?
You know how hard that is.
Yeah.
These are the two questions.
Yeah, both good questions. So the important thing to me is I measure body language quite a lot. I look at people and how they gel, how they interact with each other. It's almost like a marriage, right? When you look at a husband and wife and how they interact, it's similar to that, right? It's like a little bit of a song and dance between people. And how do they interact with each other? That language is very important. That body language is very important. I do look at education to some degree. And I do look at the ability for them to be able to be good communicators and be able to very simply describe what they do, right? Not in a long-winded fashion, very simply. Because I believe that a lot of early-stage work happens in being able to communicate succinctly to investors what you really do. A lot of people can't do that, right? And the last thing I look at, which is pertaining to the team in general, is that once you've looked at the education, once you've looked at their body language, once you've looked at everything, is what in their life have they done where they've started something from scratch? Because I'm looking for a skill, I'm not looking for experience. Because I won't find it in emerging markets. I don't generally go to someone and say, how many companies have you started? And the guy will say, 0. Well, that doesn't give me anything. But tell me something that you started from scratch, whether you were a child, whether you were a young adult or whatever, that gives me some idea that you have the skill to learn. Right? Because that skill is so much more important than experience, in my opinion, in the early stages. Right? And the propensity to learn is very difficult. It's not easy. Right? People have to reinvent themselves over and over again in the business, and you need to know when to turn left and when to turn right. And by the way, every business plan that I've seen and invested in has had to turn left or right at some point in time because market changed, business changed, whatever, right? And the entrepreneur's ability to make that turn quickly is what separates them from success and failure. a lot of times. So I'm kind of looking for that particular instance that they can tell me, somewhat of like an interviewing process, but I do it in a very soft manner, right? Just to get a familiarity going. The last thing is chemistry. I've got to like them, they've got to like me. And by the way, if we don't like each other, we better not be married, right? Because if we are, we're going to make each other's life miserable for the rest of our lives together. And by the way, as long as I have my $1 in you, your life is miserable, right? So it's not good for anyone, right? So the better thing is to make sure that we both have a good chemistry to be able to work together, to listen to each other, to respect each other's opinion, etc. So that's what I kind of roughly look at from the team. The second question you had was around valuation. So let me turn that around to you. A lot of people, because the internet is so open nowadays, will go out and say, oh, so, Facebook got a $15 billion valuation, so I should get one, right? Or, so-and-so Airbnb got, $20 million, and so I should get one. Or Twitbit got $11 million, so I should get some, right? You have to understand the environment they're in, you have to understand the addressable market that they have, and you have to also understand the networks that they're with, right? A company that's invested on by Sequoia is far more valuable than a company that is not invested by Sequoia. Why? Because they bring a lot of value to the table. That's why people like to have Intel Capital on their cap table, right? Because they think that we bring a lot of value, intangible value. You may not bring monetary value, that's your job, right? So it's important to understand. The second thing, you are mistaken that you have the same size of market. American market is a 400 million person market, highly homogenized, well connected. The UK market is roughly 80, 90 million, 110 million, whatever it is, very well connected. So these are big, meaningful markets. You have what, 87, 100 million? I don't know, how many million people live here? 80 million people, right? 80 million people. Now, and then you start digging in and you realize you have a very thin sliver here, and then a little bit of a sliver here, and then a big sliver over here, and then you go, oh, I got an 85 million market. I say, what do you sell them? What's your average selling price? Oh, I said $5 a month. I say, okay. Try selling that guy who pushes a cart and sells tomatoes on the road $5 a month, and he'll tell you to go away. Right? So you have to understand that, in that context, you have to value yourself, right? So the best people I've seen are the people who are pragmatic about it, realistic about it, and they come and basically present the business. They are clear about what kind of dilution they're happy to have, and that's it. And they then ask us to be able to help them with the process of evaluation and valuation in
I
general.
really want to say is they do a good marketing plan.
Correct.
Realistic in their go-to-market.
Realistic in a go-to-market.
They don't have crazy sales figures, they have realistic costs.
Correct.
They work it all out in a nice spreadsheet, they NPV the whole thing, and a nice round number comes out of them. Bingo, I'm worth 10 million.
NPV is worthless. In an early stage, what NPV? You have no history, right? So, I wouldn't even, if somebody comes and says, I did the NPV, I'd say, go away. Because you know what? It net present value of future earnings. You don't have a future. Well, when you get the future, come and tell me, right? So all those future earnings are worth nothing, right? So it's important that we look at multiples, which is basically what are companies being valued like to like. So if I go and look at an 85 million population market, it's roughly the same kind of a distribution, what would I be paying for it in, let's say, Chile or Argentina, right? Similar kind of a makeup. Sort of, for the sake of argument, right? I'm not saying those two countries compare with each other, but I'm just saying generally, right? So, Brazil would, comparison, you can make things happen, right? But unlikely if people just come in and say, oh, they're getting this in America, so we're going to get this. It just doesn't work that way. You had a question over there in the back.
What about the PC with the social business? For instance, I have a call center, it is the first call center in the Middle East and Africa.
Mm-hmm.
We hire disabled people.
Yeah.
The value in the idea, the
Yeah.
value in the social business, in the social side.
So, I have a friend, I'm sure you know, I'm sure you've heard of Tim Draper. Tim Draper invested in Skype, right? I was sitting, so Tim made lots of money on Skype, right? I mean, he was an early stage investor. His whole family are VCs, they run DFJ, Draper Fisher Jewelson, right? So he was sitting next to me one time, and this same question came up. And Tim said it very nicely. He said, I'm not in the business of being social. I'm in the business of taking money, making lots of it, and giving it back. And the way I give it back is I invest in thousands of businesses. That's my way of giving, right? So while I do understand your social vision, right, VCs generally are more looking at the bottom line and saying, our way of giving is different than your way of giving. Your way of giving is to give to the disabled and give them jobs. I have another company, I've invested in Jordan. You know, they give jobs to housewives, which is great, right? I get a lot of PR for it. A lot of Jordanian housewives have children. They don't want to go to work. They work from home. I said, great, perfect. You know, I don't make a big deal out of it. I don't go and say, oh, I'm going to write a big PR story that Intel is investing in disadvantaged women in Jordan. That's not what my game. My game is make me good money, and I will make sure that I will convince my management to take that entire cash pile and reinvest it back in the economy, because that's the way I give. Right? So it's a different way.
To which extent you can say that having a management framework is important at these early stages for entrepreneurs?
Not important.
Not important?
No. I'll tell you why. Most companies are, in the early stage, are chaotic, right? The guy needs to be able to mop the floor, make the tea, and be the CEO all on the same day, right? So management structure doesn't come too much into play at the early stages of a life, because you really want that spirit, right? You want that spirit of ownership. When you walk down the road and you see a piece of paper sitting on the floor, you need to be able to have the CEO pick it up and put it in the bin. Because if you can't do that, that means he's not respecting the company he works in, right? So frameworks come in a bit later in life, and they do come, by the way. I do look at them, but at a later stage, slightly later stage. When you've got the money, you've got the ability to build some sort of an HR system, when you've got the ability to figure out what your remunerations are going to be and motivations are going to be, you build that management framework at that point in time. However, I do want roles. Yeah, I do want roles. I want a CEO, I want to see a CFO, I want to see a chief marketing officer. You can call them whatever you want, director, whatever. I mean, I'm not into titles. Call them whatever you want, as long as they do a role, right? And that role is more important than structure.
Can I debate a little?
Yeah, sure.
One of the ingredients that were related to having transparency and having how you structure your business to become investor friendly and have kind of governance over the company. I think that this is related to management somehow.
Yeah.
Without the management framework, without rules definition, without strategy from top to bottom, I don't think that this will be.
Yeah. So I think let's not confuse strategy. Strategy, I agree, has to happen, right? Some sort of basic framework around governance has to happen. But what I meant by management structure is an organizational structure. I don't want somebody to come in and put a PowerPoint foil that says, here's one big box, CEO, and then it's got 4 other boxes here and 2 other boxes. I don't really care about that. That's not the boxes I'm interested in. I'm interested in is that I walk in, and in fact today I was talking to the new gentleman who's running Teak, and I said, where's the incubator? I want to go walk into the incubator and go see it. And he was like, oh, well, I'll find somebody to walk you there. I said, why? I'll take my tie off, I'll look like one of you, and I'll just go walk and talk to the few people, see what they're doing. Right? Because I want to get the spirit of how things work. So at the early stages, that spirit is more important to me than the structure, because it's easy for me to turn around and say, oh, go talk to my CEO. Well, I'm sorry, in an early stage, you could be the CEO, they could be the CEO, they could be the CEO. Who knows, right? Yeah. So it's about ownership, right?
The strategy I'm talking about is the exit strategy, and your analysis of.
Yeah, then you build your organization the way you want to build it. I think there was another question in the back somewhere. Yeah.
This is almost, valuation based on the concepts. There's no certain role. I did a lot of presentation to VCs, and each one had a different valuation. And the thing is, they are so greedy. They want to take a big stake and give you nothing, and you do all the hard work, and then.
Well, they're not for you, right? Simple. So you're right. So there are kings, and there are kingmakers, right?
Sure.
Kingmakers never become kings, and kings never become kingmakers. Right? So what I mean by that is very simple, right? You have to work with a VC that respects that boundary, right? So I always say to people, and when I invest, first of all, Intel is only a minority investor, so we never take majority. And the reason we never take majority is because the wealth of distribution normally should happen to the entrepreneur. I want the guy who I'm talking to get wealthy. I'll get wealthy as a consequence of that person, but not at the expense of that person. I don't want an employee. I'm not looking for one, right? So I'm the kingmaker, but you're the king. So you have to understand the difference between that. So if the VC cannot understand who the kingmaker is and who the king is, you don't deal with them. That's not the right VC you want to deal with. So it's important. The other thing is early stages require a lot of dilution. And you have to also respect that. Because remember that VC is taking a risk. And that risk entails a lot of dilution. So if you are looking at seed, for instance, very, very early stage, for just an idea, you have no market, nothing, get ready for good dilution, right? But as the days go by, you'll realize that that dilution effect falls very quickly because you're making more and more and more money, you're getting wealthier and wealthier and bigger, and as I said earlier, a small share of a big pie is better than all of nothing, right? So it's all a balancing act, and it's all a mixture of these things happening. And by the way, you're right. Everybody has different styles, everybody has different methodologies, and you have to make sure that the person is right for you. I've had companies come to me at a much worse valuation. I've given them a valuation that they would hate, but they've still come to me and said, you know what, in retrospect, I'd rather be with Intel, because I can get more money from somebody else, but I don't get their network. I don't get to be invited to the US to meet up with all the other technology partners. I don't get to see the exposure that Intel brings to us. I don't get to see the overall marketplace that they create for us. So you know what, I'll give you a lower valuation today, because the upside is so much bigger. The future is so bright. Versus, oh, I'll take the 10 million this guy's giving me, and then the guy knocks you on day 2 and goes, what, is it $1.10 yet? Is it $1.20 yet? Right? How many knocks are you going to take?
Yeah, I mean, sometimes, all the time, they're greedy. They want to take the big part and they want to control everything.
They're not for you then. Find somebody else.
Yeah. I mean, like I said, it's perfect.
Find somebody else.
Is 50% for a $100,000 investment, is that greedy? If it is just an idea, it's a massive risk.
No, it's not greedy. No.
I don't think it is at all.
No,
I hear that word all the time, and young investors all the time say, he wants too much for only $100,000, while they have barely 10 pounds in their pockets.
No, it's not greedy.
Well, that's good.
I mean, ideas are worth nothing, as I said. You know, ideas are worth nothing. Execute.
As you two are non-musicians, let me say that unfortunately, entrepreneurs in Egypt, especially the young ones, have a massive problem. If I give you a slight example, a gentleman supposedly has invented an electronic voting system and came to us. He had an idea, and he wanted to make the jackpots, okay, immediately, and does not want to talk. And the other word you mentioned is the pitch. Oftentimes you have people who are technically well or seem to have a good idea, but don't speak the language of VCs and business and cannot present their case well, and are not willing to, first of all, let go of information. Part of the making money, they always look what the VC or what the investor makes, not that they survive, because in the initial stage, the entrepreneur should actually focus on survival, that they get their ideas through, because even 10% of a larger company.
I agree with you, but you know, see the difference is that this formula that you're talking about is well established in the Silicon Valley, for instance. Right? Nobody talks about valuation per se in Silicon Valley. Why? Because it's a formula. Nobody talks about documentation in Silicon Valley. It's a formula. Here, jurisdictions are different, legal paperwork is different, it costs a lot more money, it takes a lot more time, and the concern around the entrepreneur. I mean, I have a wall of business plans that I put as a joke. I mean, I call them my wall of hilarious business plan. Right? But people will send me a one-pager saying that they're going to change the world and they're looking for $50 million. And I'm saying, well, what? Right? And they say, I can't tell you. Secret. I said, keep it. Right? So I've got a few of those, right? So there are people like that as well. But, you know, as I said to you, find a new VC, find a new company. There are many of them, right? So I don't waste my time with them. I don't spend, you know, too much energy on it. I think it's humorous. I put it in my system and I keep it. But important thing is that you have to go get there from somewhere, right? So I think the real key is to figure out if we collectively can find 1, 2, 3 entrepreneurs and make them successful, like SysDSoft and others, that people can emulate, that they can look and go, okay, well, how did he build this company from something? Maybe I can do that, and look how realistically he did it, or she did it. And maybe I can follow the same path and realistically do it. So those examples are so much more important, because if you don't have any examples and you're in the blue ocean, you know, and you look everywhere and there's nothing around, what are you going to do, right? You're going to have to make up something.
For whatever it's worth, the advice I give young entrepreneurs is if their passion is only in making a bundle, then there's little point in talking to VCs who are looking for people whose passion is in getting the product out to as many users,
As possible, yeah.
If you're crazy about dough,
Yeah,
don't ask
and the
for
dough
it.
comes, by the way. The dough comes later, but it does come.
You keep on mentioning SysDSoft. Can you please tell us how they approached you and why you invested in
So I've known them for a long, long time, right? I've known them since 2005, 4 or 5, something like that, right? So the way it happened was, I don't know if you remember, a long time ago, Intel used to do WiMAX. We were very much focused on WiMAX there. We didn't really care too much about LTE, which is a kind of a different technology. WiMAX is very data-centric, and LTE is voice and data, right? And the LTE is supported by Ericsson and the telcos, and the WiMAX was supported by a consortium of data-centric people, right? So we were talking to them about the company for a long, long time, but we never really matched from a technology perspective. So when Intel bought IMC, which is Infineon in Germany, with that came the realization that we will also look at LTE, and SysDSoft happened to be filling that antenna gap or antenna stack gap, which we had. So the choice was very simple. We continue to feed them business or buy them. Right? Make, buy. Okay? So could we have invented what SysDSoft did? Sure we could. Right? I mean, do we have a shortage of engineers? No. But something was ready-made. It was already slotting extremely well. It was like a jigsaw puzzle. We said, you know what? If we give them a good enough reason to leave and exit and become a part of Intel, they will. So we gave them a number, they liked the number, right? And the deal happened, right? I was only peripherally involved in it because I'm a minority investor, I don't do acquisitions, but I helped the team